Ethically Speaking is a podcast of the Institute for Enterprise Ethics at the Daniels College of Business.
Welcome to episode 7 of Ethically Speaking. This morning we're going to talk about corporate governance for long-term performance. Boards of directors are generally expected to govern in the long-term best interest of the corporation. However, in this age of shareholder activism and short-term Wall Street expectations, maintaining a steady focus on long-term performance can be very difficult. Yet, some company boards successfully resist the temptation of quarter-to-quarter governance and are able to sustain a steady fix on the future. How do these boards keep this long-term focus? I have with me Bill Heck to discuss this question. Bill is a principal of Harlon Group, counselors to corporations on executive compensation and governance. He is the current chairman of the Colorado chapter of the National Association of Corporate Directors, and he is a member of the Institute for Enterprise Ethics Steering Committee. So, Bill, what were some of the most interesting things you heard about governing for long-term performance this morning?
Well, first of all, Dan, I think I know that the program this morning was outstanding. We had some great participation from our panelists, and I hope that the audience learned a lot. I think, as pointed out by the National Association of Corporate Directors' Blue Ribbon Report on the board and long-term value creation, the board needs to maintain a direct connection and alignment between short-term objectives and goals and long-term strategy. It was pointed out by Tracy Zhu this morning in our presentation that there needs to be a clear balance between clear objectives in terms of short-term goals and long-term objectives. That balance needs to be maintained by the board. There needs to be a discipline in the board to continue to discuss that balance and to continue to recalibrate that balance. There needs to be full board engagement in identifying and continuing to perform against long-term value creation. By that, Tracy was meaning that instead of having that job or that chore assigned only to a committee, there needs to be full board conversation around that. In these days where it is important for a company to be chasing the yield, it's very difficult for boards and for management teams to continue to focus on long-term growth through their long-term strategy. Building discipline around that is very important. Building discipline in ways that make sense for the company. For example, putting in incentive goals and metrics in the long-term incentive plan as well as the short-term incentive plan that balances performance against both the short-term and long-term. Putting conditions of discipline and responsibility around having conversations about continuously reviewing where the organization is performing against strategic initiatives and making sure that that is communicated, both the strategic plan development as well as the implementation of that plan, communicated often with shareholders, whether they be privately held company shareholders or publicly held shareholders. So it's a matter of discipline, introducing discipline into the organization, and it's a matter of understanding what the organization is all about. One of our panelists, Mark Jensen, mentioned one of the first questions that a board should be asking is, what are we all about? What should we be doing? And then from there, moving into a clear definition of long-term value.
You know, Bill, one of the things that interested me this morning was the conversation about the relationship between developing a long-term strategy, which obviously has milestones, and then linking that to long-term financial performance, linking that back to the governance process. And one of the more interesting things I think he said was, the hard part is not developing the strategy, the hard part is sticking to it.
Yeah, and that's where I picked up from this morning's conversation a real keen insight, and that is that you have to build structure around that. For many years at the board level, we've had directors push back and say what we need is information from the management team, and then we need to comment. More often and more recently is board and directors needing structure around the conversations that they're having. So to be honest about holding to implementing strategy, there needs to be an opportunity to be able to measure how well you're doing, and there needs to be an opportunity of courage to talk about it. That is, if the strategy isn't heading in the direction that the director thinks it should be heading, then there ought to be courage on the director's part of having that conversation in the boardroom with their fellow directors about either tweaking the strategy or seriously looking at the intent of the strategy, and is the intent of the strategy being fulfilled.
I thought that was a very good dialogue among the panel this morning. I think the audience was very engaged in it as well. Thank you very much. Why is it, Bill, that many boards are just not willing or maybe not able to focus on the long-term performance of their businesses?
Well, traditionally what boards have been saddled with is a responsibility either to the street or to their private investors to make sure that they are tracking on a quarterly basis or on a monthly basis the goals that they set for their annual plans. A comment was made this morning by Mark Jensen, one of our panelists, that there are two types of boards that he gave caution to make sure that we know about. One is a compliance board and one is a guidance board. It's the compliance board, that is the directors of a board who are more focused on complying to the responsibilities of board governance as well as the responsibilities they have to their shareholders. That focus on quarterly or monthly results. And so what they're receiving from their management team is historical reporting of how well the company has been doing. And what we need more of is directors and full boards who are focused on being a guidance board. That is a board who provides guidance of what the future may look like and some of the risks that are out there in the future. Clearly, a board of directors' responsibility in part are threefold. One, making sure the strategy is in place and implemented. Two, making sure that they've got good senior leadership team on board. And three, that they are understanding and mitigating their risks correctly. It's in that risk category that directors oftentimes fall down. They spend more time on the compliance side worrying about whether or not they made their annual or their quarterly goals than looking forward 18, 24, 36 months and even into a 10-year time frame and asking the question, what do we see down the road that really is going to cause problems to allow us not to meet our long-term value creation goals that are found in the long-term strategy. So the admonition would be that I picked up from the conversation this morning is that we should, as directors, be much more committed to becoming guides as opposed to becoming individuals who seek for compliance.
You know, the other side of that question, Bill, is over the past 15 years, a lot more compliance responsibilities have been sent the board's way. There's a lot more regulations and a lot more processes that are stipulated by the SEC or some other Department of Justice entity, and it just does take up a great deal of time.
That's often a conversation that we hear, and what we're hearing is that, as we heard this morning in the presentation, one of our audience members said that the average board member is spending 240, 250 hours a year on their board. If you're on 2 or 3 boards, then you're up to almost a full-time job, 1,500 hours out of 2,000 hours. What we're hearing more often than not is what we ought to be spending our time on are those things that we can actually have impact on as directors. And so the question to the director is, are you going to have impact on meeting an SEC requirement or an ISS guidance or a Glass-Lewis guidance, or are you going to have impact on actually adding value to however you're measuring value? If you're measuring value relative to chasing the yield on an EBITDA level or measuring value based upon shareholder value on the balance sheet side, that's where you ought to be focusing your attention. It takes a lot of courage on a director's part to stop and engage the board in a 5 or 10 minute conversation about focusing on long-term strategy. It's that courage that's needed in the face of compliance, in the face of more and more responsibilities that we get, not only through federal agencies, but through our investors, oftentimes our active investors who are asking more and more questions of us. So it is a balance. I appreciate that, but I would caution that the director should err on the side of more conversations relative to long-term strategy.
Well, there certainly is a lot of tension between this goal of long-term performance and the demands of short-term returns, and thanks for those insights. Bill, when dealing with long-term performance and dealing kind of at the same time with issues of short-term demands by various stakeholders, do different issues of ethics and integrity and responsibility arise, especially when making trade-offs between the long-term and the short-term?
Yeah, it's an interesting question, a question that probably doesn't have too much academic background to it, but from the standpoint of the director's point of view, obviously ethical situations or trouble that I could get into if there's an ethical dilemma presented to the board would arise more often, and oftentimes arise more often when discussing short-term goals and objectives, that is the annual business plan. Discussing long-term strategic initiatives and doing planning on that in that arena oftentimes doesn't arise to the level of having discussions around ethics. However, the dynamics are exactly the same. You can still make the same decisions that are ethically challenging in the long-term arena that you can in the short-term arena. So let's talk about capital allocation for a moment, which is a major issue around long-term strategy. Capital allocation, or the allocation of capital from a company, oftentimes is thought of in a short-term arena. It's thought of in terms of dividend, it's thought of in terms of value to the company through buybacks, etc. And secondly, it's thought of where should we be expending our capital over the long term? What should be our CapEx over the long term? If we think about that for a moment, those capital expenditures over the long term have much more opportunity for ethical dilemmas arising than oftentimes the short-term capital expenditures. So on the long-term capital expenditures arena, for example, we're shifting directions on strategy potentially. We're getting into new asset classes. We're moving into new markets. We're opening up global logistics opportunities that create larger, greater opportunity for discussions around ethics. So there should be a lot more discussion about ethics on the long-term value creation side, long-term strategy side. What happens is we back into those, we make decisions on the long-term strategy side, and then we back into those kinds of discussions on the ethics side by asking after the fact, what kind of ethical opportunities do we have here in terms of ethical dilemmas, decisions that are not ethically correct? We should be putting those more to the front end.
It's been my experience both on boards and as a consultant to companies that those issues hardly ever come up in the process of developing a strategy and making strategic choices.
And respond to that kind of a comment, Dan, oftentimes by going back to a gentleman that the Institute for Enterprise Ethics owes a lot, Bowie Sewell, who is on faculty here at DU Daniels. In a presentation I made many years ago about ethics in the boardroom, it was summed up by a very smart and a very cogent response or comment from Bowie at the very end of the comment. And he said it all boils down to the ability of a director to be able to show courage. And those types of conversations that need to be had around ethics, in my view, are started at the director's level in the boardroom by individuals who demonstrate a whole lot of courage. By that is courage of conviction, courage of knowledge, courage of understanding, and courage that they have faith and commitment to a good outcome in that conversation. My response oftentimes to that kind of comment, Dan, is we've got to look for the director who clearly has the highest level of characteristics that denote that person having courage.
Well, we can always count on Bowie, whether he's here in person or not, to cut through the muck for us. So thanks for bringing that up, Bill.
Thank you, Dan.
So, Bill, how do activist investors play into the situation of long-term versus short-term performance?
You know, that's an interesting question, and I feel that we've had an opportunity to hear a lot about activism in the past few years, and I'm sure we have an opportunity to learn more about it as we go forward. Two types of activists that we're most familiar with are social activists and financial activists. It's the financial activist who will take advantage of this gray space between short-term views and long-term views that boards and management should have. And what the financial activist is looking for in that regard is a lack of reporting on long-term value creation. That is, looking through a public company's discussion in the proxy around their 10Qs and their 10Ks. They're looking for information about how well the board and the management team has treated long-term value creation. And when not finding that, then they're able to put together a convincing argument to the board and to the management team that they, as a minority shareholder, ought to have more voice in terms of doing things that need to get done for long-term value creation. So attention to that balance between short-term business goals and long-term strategic goals is really a key to understanding understanding more where your activists might be coming from. The more you communicate that balance, that you're focused on both of those, and both of those are well balanced in your thinking and in your execution of both business plan and strategy, the less opportunity you're going to have, in this arena anyway, for an activist to be able to introduce themselves. So they identified companies with the potential. They're not doing a great job around communicating with their shareholders. And by that I mean what they're not doing, what the company is not doing, is consistently letting their shareholders know what responsibilities they have as a company in terms of going forward, not only to their shareholders, but to their stakeholders also, to their customers and to their employees. What they're doing in that arena, what ought they be doing in that arena, such that the activist then has an opportunity to create their own dialogue and create their own spreadsheets with this vacuum of communications. In this morning's conversation, we heard some great dialogue about communications and the need to communicate with all shareholders in order to make sure that you're talking to the activist, because as one of our panelists indicated, you don't know where the activist is coming from, especially in a smaller publicly held company, let's say in $500 million company with a $600 million market value. There is less opportunity in that kind of a platform to be able to do a lot of deep dives in your investor relations arena and find out where your activists might be coming from. But being able to communicate this balance that the company is working hard on both the short-term objectives and the long-term creation value objectives is a real key place to start in terms of that communications.
Yes, we had I think, quite an insightful conversation this morning among the panel and the audience on this issue of the activist investors. They've had some experience dealing with them. I feel that was a nice, succinct summary of that. Thank you very much.
Thank you, Dan.
Can you suggest a couple, 2 or 3 specific actions that boards or individual independent directors can take to reorient the board's focus toward the longer term?
Great question. That's a question that perplexes a number of boards and a number of directors. I think there's 3 or 4 things that we learned this morning clearly from this presentation. First of all, creating and holding to a continuous view and strategy. That is, having a clear understanding of what that strategy is among board members, all the way from inception to concurrence through implementation and tracking, and making sure that the directors speak that strategy at all times. If that strategy shifts or if there's a pivot in strategy, then there's concurrence that's happening, and that needs to be communicated too, in the sense that the company is taking a different tack, and here's the value of making sure that that tack will prove successful in the future. So that holding to a continuous view on the strategy. Simply another idea that came out of this morning's session was to create more time in meeting agendas to discuss progress on strategy. Having less time to talk about the operational and the current plan year activity among the board members who meet once a quarter and have conversations in committee and various other conversations in between, to talk about strategy and holding yourselves responsible as directors to make sure that you do have that conversation. And then tie discussions on capital allocations to the annual budgeting process and to long-term strategy. Oftentimes, capital allocation conversations occur at the end of the year or the beginning of the year, and we sort of let them take a track of their own. What we ought to be doing is making sure that we're tracking those capital allocations through having conversations put on the agenda at quarterly board meetings that talk about the success of those allocations and whether or not they're doing what we should be doing, which then would heighten the conversation around how well are we doing as a board in monitoring the exercise of long-term strategy. Assuring board composition includes finding skill sets and experience to provide insights on tracking strategic initiatives. Do you have the right mindset among directors in terms of understanding what it takes to actually put in being and having it be successful implementation of strategic initiatives? And those skill sets come from a number of areas. They come from manufacturing backgrounds. They come from backgrounds of administrative C-suite folks. They come from backgrounds of marketing folks who have been responsible over their careers to make sure that those strategic initiatives come about. Communicating to the shareholders, whether they're private or public, shareholders where you are in terms of meeting those strategic initiatives. If you communicate something that you said is going to cause success in the organization, then you're going to be a bit more rigorous in terms of making sure that happens. And in that communications piece for a minute, Dan, it's important that the shareholders, especially in a publicly held company, are spoken with early and often. And the best folks to speak with them clearly is the CEO on the operations of the organization, how well the organization is doing, and the chair of the board in terms of is the company on track relative to meeting its strategic initiatives. The chair is responsible for strategy in this set of communications with shareholders, and the CEO is responsible for assuring the shareholders that current state of business is well in hand and the organization is progressing along.
Quite a few tasks for a board that's truly engaged to take on. They're going to be busy.
And I think one of the challenges that we have at the Institute for Enterprise Ethics is to make sure that that focus of long-term strategy continues, and that in that conversation on long-term strategy, there is always a top-of-mind conversation around are we doing ethically what we should be doing right for the company?
I would agree to that.
Ethically Speaking is a podcast of the Institute for Enterprise Ethics at the Daniels College of Business.